In February 2026, the American stock market lost $1 trillion in 3 days. No bank collapsed, no war started, no pandemic hit. Nothing you'd see on the news as the cause. And that's exactly what should scare you. Let's back up. For most of 2025, the U.S. stock market was on a tear. Tech stocks especially, fueled by the AI boom. Every week, another company seemed to hit a new record, and everyone wanted a piece of it. Not just Wall Street. Teachers, students, office workers, even retirees were trading straight from their phones, using something called margin, basically borrowed money, to bet bigger than they could actually afford. At the same time, a new kind of trading exploded in popularity. Options that expire the same day they're bought. Traders call them zero-day options. Think of it as a bet you have to win or lose before dinner. By early 2026, these same-day bets made up more than half of all options traded in a single day. Here's the part nobody explained simply. When millions of people buy these short-term bets, the banks and firms on the other side of the trade have to protect themselves. So they buy or sell huge amounts of stock instantly to balance their own risk. This is called gamma hedging. Imagine an entire boat filled with people. If everyone leans to one side, the boat starts moving. Then everyone leans even further, trying to keep their balance. Soon the movement becomes bigger than the people who started it. For months, that invisible force kept pushing prices higher. Then, in early February, something small spooked the market. A disappointing earnings report from one of the most hyped AI companies on the planet, its stock dropping over 20% in a single session. Nothing dramatic on its own. But this time, the lean went the other way. And the panic didn't stay quiet. Within hours, some of the biggest trading apps in the country froze the buy button entirely. The same thing that happened during the GameStop frenzy years earlier. Millions of everyday traders watched their portfolios crash in real time, unable to do anything but sell. Fear spreads faster when people believe they have no control. And here's the mechanism that turned a wobble into a collapse. Margin calls. Remember all that borrowed money? When stock prices drop, brokers demand it back immediately, no negotiation. If you can't pay, they sell your stocks for you automatically, which pushes prices down further, which triggers more margin calls, which forces more selling. Nobody has to press a panic button. The system does it automatically. That's the frightening part. It's a system with far more machinery built to push prices down fast than to pull them back up. Nothing forces buying. Everything can force selling. Within 48 hours, the damage spread far beyond tech stocks. Bitcoin, supposedly disconnected from traditional markets, lost nearly half its value. Silver had its worst single day since 1980. Gold, which had just hit a record high days earlier, dropped over 10% in one afternoon. Investors were so spooked they pulled $83 billion into cash and safe assets in a single week. The strange part, every one of these markets is supposed to be diversified from the others. That's the whole pitch of spreading your money around. But in a crisis, hidden threads connect everything. Currency trades, hedge fund positions, automated trading algorithms, they all activate at once. Diversification works great until the one moment you actually need it. Within days, lawmakers in Washington were demanding answers. Congressional hearings were scheduled. Regulators promised a full investigation into whether same-day options and automated trading needed new rules. It was, in many ways, the same promise investors heard back in 2008. So who caused it? Nobody really. And everybody. There was no single villain to blame. No fraudulent CEO. No secret meeting in a boardroom. Just millions of small, reasonable-looking bets stacked on top of each other until the stack collapsed under its own weight. In the weeks that followed, the market clawed back some of its losses. Headlines moved on, but for millions of ordinary investors checking their retirement accounts, the damage was already done. The next trillion-dollar crash probably won't begin with a war, or a virus, or a bank collapsing. It may begin with millions of perfectly ordinary people making perfectly ordinary decisions, one click at a time.